If you give me just a few minutes, I'm going to show you one of the most powerful risk tools on TradingView. When you trade, you're always exposed to risk. You can't remove it completely, but you can measure it and manage it properly. And this indicator I'm about to show you does exactly that. It's called the fair value bands, created by Quantify Tools. Once you see how it works, you'll understand how to measure risk in a whole new way and how to use it for smarter trading decisions. So let's get it on the chart. Open TradingView, load any market and time frame you want, then click on Indicators from here. Then type Fair Value Bands. Select the one by Quantify Tools. The moment you add it, you'll see colored bands overlaid on your chart. These bands may look similar to Bollinger Bands or Keltner channels, but the calculations are completely different. Instead of constantly shifting with volatility, the fair value bands use historical deviation, which makes them smoother, steadier, and far more reliable for measuring risk. Now, let's quickly set it up.
Do you feel like everyone around you benefits from artificial intelligence, but you have no idea where to start? Don't wait any longer. Start today. Our free trading bot is simple to use, powered by artificial intelligence, and can earn you up to 1% profit every single day. Over 500 members have already joined. Click the link below now to get free access. This is your chance to harness the power of AI and take a step toward a financial boost.
Open the settings first of all. You can do that from here. Then, in the Inputs tab, scroll down and uncheck Inputs in Status line to clean things up. Then head over to the Style tab, scroll down, for the fair value basis. Increase opacity to 80% for both white and red colors. This is necessary to make the major elements of the indicator pop out on the trading chart. For fair value deviation 1x, set both the upper and lower bands to 50% opacity. Of course, you can change these settings according to your preference. For the extreme fair value deviation, set both the upper and lower bands to 30% opacity. Once you do this, the chart is crystal clear and the levels are easy to see and understand on the trading chart. Now, let's break it down. The middle line is our fair value. By default, it's a simple moving average with length 20. When price is above it, the line turns white. When price is below it, the line turns red. But here's the important part. We don't use this line to predict direction. We use it as the market's fair value. And the key is to measure how far price deviates from this fair value. That deviation is our risk measure. The first band above and below the fair value line creates the fair value area. When price is inside this zone, it's considered low risk. If price is above the line but inside the first band, the bias is up. If it's below the line but inside the first band, the bias is down. Once price moves outside this fair value area into the next zones, things change. Between the first and second bands is considered high risk. Between the second and third bands is considered highest risk. These zones are highlighted red or blue. Blue shows extreme downside risk, red shows extreme upside risk. The indicator even comes with a table that tracks the statistics of how often price is in each area. Each zone is given a number. 0 is the fair value area, 1 and -1 are the first deviations, 2 and -2 are the second, 3 and -3 are the extremes. On most charts, you'll notice that over 90% of the time, price stays inside the fair value area. Only a small percentage of the time does it move into the higher risk zones, and very rarely does it push into the extreme zones. But when it does, that's when you know risk is at its highest and a reversal back to fair value becomes likely. Think about it like this. When the market is trending strongly and price pushes way outside the fair value area into the highest risk zone, volume also spikes. That's usually when traders are chasing the move, but statistically, those are the areas where price is most likely to turn back toward fair value. So when you see price far below the fair value line in the extreme blue zone, the bias is down, but the probability of a reversal upside is also high. When you see price far above the fair value line in the extreme red zone, the bias is up, but the probability of a reversal back down to fair value is high. Let's go through some real examples so you can see how this plays out. In the first example, price was trending lower and the fair value line was red. After a sharp drop, price extended deep into the extreme blue zone. This was a textbook high-risk condition. At the same time, volume spiked heavily, showing panic selling. But because this zone represents the highest risk, It also offered a reversal opportunity. Soon after, we saw a bullish candle form. That was enough confirmation. A buy trade can be entered here with stop just under the extreme low, as we can see the price quickly push back toward fair value. The move didn't just retrace, it reached the fair value center line within a handful of candles and delivered a clean, low-risk reversal trade. In the second example, the opposite happened. Price had been trending up strongly with the fair value line white. After a long push, it extended into the extreme red zone. Volume surged as buyers piled in, but the market was stretched far from fair value. This was the highest risk condition. Not long after, a sharp bearish candle formed, showing rejection at the top. That was our signal. Entering a sell trade right after that candle with a stop above the high in this situation can give us a perfect trade most of the time. Of course, there are exceptions, and the price can move in the same direction and your stop loss could have been hit. In this example, the price reversed smoothly, dropped out of the red zone, and returned to the fair value line, again hitting target quickly. The reason this works is simple. The fair value bands are built around probabilities. Most of the time, price stays in the fair value area. The further it stretches, the higher the risk, and the higher the chance it will snap back. That's why reversals from the extreme zones happen so often. And that's exactly how you can use this indicator for mean reversion strategies. You can also combine the fair value bands with another indicator for extra confirmation. A great option is the RSI. For example, let me quickly add the RSI indicator to the trading chart. So this is how you can use this indicator with RSI. When price pushes into the extreme blue zone and at the same time RSI is showing oversold conditions, that's double confirmation for a possible reversal back to fair value, and there are more chances of a profitable buy position over here. And when price stretches into the extreme red zone with RSI overbought, that's another high probability setup for a reversal down. It is a quick filter that makes the signals from fair value bands even more reliable. So to wrap it up, the fair value bands indicator shows you exactly where the market's fair value lies, how far price has stretched away from it, and what level of risk you're dealing with. The closer price is to the fair value, the lower the risk. The farther it is, the higher the risk. And when price is in the extreme zones, you know you're at the highest risk, but also where the biggest reversal opportunities can happen. It is as simple as that. Test it for yourself, practice spotting these perfect setups, and it could quickly become one of your most reliable trading tools. Thanks for watching the video till the end. If you found value in this breakdown, make sure to hit like, drop a comment, and subscribe so you don't miss the next one. I'll see you guys in the next video.